Welcome to Yahoo Finance Live. I'm Julie Hyman. That's Josh Lipton. We're here at the New York Stock Exchange, bringing you what you need to know at 3 p.m. Eastern. The Nasdaq falling deeper into correction territory, dragged by weakness in Meta and Alphabet shares. The S&P 500 nearing correction as well. It's shedding more than 1%, or was shedding more than 1% today. Now it's up about a half of 1%. And we've got more tech earnings after the bell from Amazon and Intel. We'll have the breaking results and instant analysis.
And FTX founder Sam Bankman-Fried testifying in his own defense today, but not in the presence of the jury. The judge has sent the jury home, and we'll hear SBF's testimony to decide if any of it is admissible. Bankman-Fried has pleaded not guilty to 7 counts of fraud and conspiracy related to the collapse of his crypto exchange. We're going to dig into his decision to testify and the judge's decision to send the jury home with a former federal prosecutor.
And the UAW and Ford have tentatively reached an agreement after nearly 6 weeks of strikes. The union says the deal includes 25% wage increases over the course of 4.5 years, adjustments for cost of living, and the right to strike over plant closures. The news coming just ahead of Ford's third quarter earnings report. That's due after the bell. We'll break down the results and look at whether deals with GM and Stellantis could be on the horizon. Let's take a look at stocks right now. As I mentioned, the S&P 500 had earlier been down as much as 1%. Now it's only off by about 0.4%. The high for the S&P was back on July 31st, and it's down around 9% from those levels. So not quite in correction, but getting very close to that level. The Dow, little change today, off by about 16 points, and the Nasdaq off by 0.9%. But all three major averages backing off of their lows of the day right now. Tech still, though, as you can see, is the worst performing group.
And it's the busiest week of earnings season, and the rising rate environment taking a toll on companies. We've been digging into the earnings calls, looking for clues about how C-suite executives are feeling about higher rates and the effects on their companies. Just this morning, Honeywell narrowing its full-year guidance and citing the challenging macro environment, including higher rates. And earlier this week, IBM CEO Arvind Krishna mentioned rates as a macro headwind. Otis CEO Judy Marks blaming higher rates for declining sales in its new equipment market in the Americas. And 3M says higher rates are hurting housing-related spending. So, I mean, not surprising, Julie, that this is a topic CEOs and CFOs across what's interesting, a different number of sectors and verticals here are bringing up, because it is a more challenging environment to operating in. Your customer, it's tougher for some of your customers. If you're a CFO, it can be more challenging to refinance your debt. It's especially tough, of course, for those tech stocks, any kind of growth names. Frankly, we're kind of seeing that. I mean, when you look at the reaction in big tech earnings, it has not been great. A lot of folks were looking to this season, but let's talk about Alphabet. It's down in today's trade, reported disappointing, at least on the cloud line. That was a disappointment to a lot of investors. We can talk about Meta, which initially popped, but then gave guidance, and they are in the red as well today. It's talking about softer ad spending given the broader macro landscape. So some puts and takes here for investors to make for that.
I think you hit upon something really interesting, though, which is the reaction to these numbers. And what strikes me as I read through these conference calls and look at their commentary and interest rates, it's sort of one of a litany of challenges facing them right now. Many of these companies talking about the macroeconomic backdrop and listing interest rates among other factors that are weighing on them. So even though, I think the banks would be kind of an aside on this. Right. Obviously, interest rates are much more directly impactful to their businesses. Most of these other companies, it's sort of backdrop atmospherics, if you will. Where it is still really pinching in the markets is in perception, is in sentiment. Particularly for these growth names, higher interest rates have really been problematic. So that is something interesting to me, that we're still not getting a lot of specific effects being discussed on consumers, on companies, on debt servicing costs, for example. Not seeing as much of that as I am just this sort of background
what's interesting
noise.
Too is if the economy kept humming and the customer kept spending and you were a CFO and you're thinking, okay, my top and bottom lines are still growing, I'm going to have enough capital to refinance. But of course, there are plenty of smart economists and strategists. We're going to have some on the show today who are a little bit more worried about whether that's actually going to be true in the quarters ahead.
Right.
Yeah.
So let's talk to one of those folks that
Let's
you're
do that.
mentioning. We also, of course, had GDP today. The economy growing in the third quarter at the fastest rate since late 2021. And that move defying continued predictions for a slowdown. Many expected the Fed's policy tightening to start to constrain consumer spending. However, our next guest says the move in Treasury yields is pointing to the likelihood of a recession on the horizon. That's Tony Dwyer. He's joining us right now, Canaccord Genuity Chief Market Strategist and head of the U.S. Macro Group. Tony, it is fantastic to see you as always. You just heard Josh and I talking about we've got higher rates. Companies are sort of talking about it in the background. It didn't seem to really crimp GDP. So what's going to change here?
Well, CEOs aren't worried about it until they actually have to raise money. Look at what happened with the Treasury new issuance. I think a lot of people are looking at maybe the Treasury market has been a statement about inflation, but inflation break-evens didn't really move that much. It came down to, if you pinpoint the peak day for the S&P 500, it was July 31st. And when yields started really rising more aggressively, it was July 31st when Janet Yellen announced a third more Treasury new issuance. And I know this has become a theme a lot of people are talking about, but we had talked about it at that point. You have lost your three biggest buyers. Your Fed is doing quantitative tightening. China and Japan are protecting their own currency, and banks are under regulatory scrutiny for capital. So when you're in that situation, you get outsized moves. And our theme our written note earlier this week, higher for shorter, is a reflection of that.
And Tony, we've had plenty of smart economists and strategists on the show, and they are in this, the soft landing camp here, Tony. So recession coming back to 2% without an economic downturn. But Tony, you are not in that camp, correct? You think we are due for a recession here?
I'll give you the strategist hedge. There's really no chance that, in my view, I don't know how we avoid a recession. Our view coming in this year, Josh, was throughout the year was that a soft landing scenario is the worst case scenario because it creates that perception of higher for longer interest rates, which keeps them rising. Interest rates on the intermediate long end of the curve are up 25% from where they were in the beginning of September. So when you actually look at it's not like interest rates have just sat there. So when they move like that, it reinforces the idea that you're not going to have a soft landing because the conditions have changed. Now, earlier we were talking about CEOs aren't really responding to it yet because they haven't had to raise new money at the higher rates. When Janet Yellen announced that she was going to raise $1 trillion in Q3, that was at 5%. That's not at 0.5% or 1% where they had raised it in the past. So when you have to reissue or issue debt, that's when it becomes a bigger problem for a CEO.
Right, that does make sense. So when we're talking about higher for shorter, the thesis being that we go into a recession and then the Fed has to cut, right?
Yep, like they do. Julie, even in a soft landing scenario, if you look at 1966 or 1995, you had at least a 200 basis point move and long duration Treasury yields. So you really need a huge move coming out of the Treasuries, but also the mortgages and corporates. And that has to come from a major tone change in the Fed. And that tone change in the Fed that makes them cut rates is typically some kind of event and or dramatically weaker economic data. As an example, 1995, the mystical soft landing that everybody wants to have here, which I would love to have, frankly, too. I'd love to be wrong, is that the Orange County bankruptcy in 1994 is what drove the Fed to change their tone aggressively. The last rate hike was February of 95, but you had already seen a significant drop in Treasury mortgage and corporate rates. By that time, they raised the last time. We haven't seen that yet. We're making, or not today, but earlier this week, we made new cycle high for bond yields. So that to me is the real differentiator, is what gets the Fed to change their tone enough that you get those other instruments to have a significant rally that kickstarts an improved outlook for money.
So Tony, what's the answer to that question? And I can, obviously we don't know for sure, but like, what's the Orange County bankruptcy of 2023?
Some were thinking it might have been Silicon Valley Bank, but that was more of a one-off. To me, it typically comes in a place that nobody can see that's unregulated. And the biggest growth in the unregulated finance market is private equity, private credit. So I don't know. I wish I had insight into what's going to cause it. And I would be arrogant. We're all, it's funny you say that you had a lot of smart strategists and economists, and I don't know, you better go find one because you're in the wrong place here. But, to me, you can't figure it. By definition, it would be discounted if you knew what it could be. It's something that typically, like long-term capital in 1998, we knew that rates were going up and mortgages were becoming an issue, but nobody saw the long-term capital situation happening. Just like in 1994, nobody saw Orange County declaring bankruptcy. I don't know what it is, but in my opinion, we're getting closer to it, which is beginning to get reflected in a little bit lower yields. And as that accelerates, that could help us create at least a temporary bottom for stocks.
Yeah, I'm interested, Tony. So just given your view of the economy, that we're headed for a recession, what's an investor to do, though? What's the response to that? Is it, all right, I hear that, I buy Tony's argument, I'm fleeing stocks? Is that the move? Even as we know, Tony, a lot of names have been pretty banged up.
Yeah, exactly, Josh. So we've been called what's light and tight, meaning light in exposure, so have a little extra cash, and slightly defensive. I think the defensive areas like Utes, consumer staples, and healthcare work because they've been so decimated, and they've also been subject to those higher yields. They've been hit not just because of fundamentals, but those higher interest rates. If I'm right, and interest rates come off on weaker economic data, you're going to get those areas to lift. And we saw that yesterday. Even though you got a big hit in the market on an interest rate spike, utilities and staples outperformed. So I think if you have to be invested, I think it's not defensive because the end of the world is coming. For a lot of stocks like financials, it's already happened. I mean, the Russell 2000 is down 33%. So somebody's got to tell me it's been a great year for stocks, from peak I'm talking about. So when we're looking at it, Josh, it really is, if you are invested, it's to be in those areas that benefit from the lower interest rate environment that most people have given up on.
Yeah, it's interesting you mentioned small caps. Someone in one of our Slack channels just shared a chart of the total market cap of the Russell 2000 versus Apple's market cap, and Apple's is bigger.
Yeah.
And does, what does that kind of tell you about an inflection point? And also, what does it tell you about what you want to do with tech right now?
Well, you're getting close. You're getting to the closer. We're 2 years into this, Julie. It's not the beginning of the bear market. We're 2 years into it, especially if you're in the small cap world, and especially if you're in the even the QQQs. Let's take those, the top 10 stocks, the mega cap ones that everybody really loved, and it had a huge year. They're still well below peak. They were bouncing back from an enormous decline into the end of last year. So our view is while you're how do you know when you get closer to the end of a decline, like a longer duration decline? They shoot the winners. And now you're seeing some of that in the mega cap stocks that are under a little bit of pressure that even had good earnings, but they're still down, and they're down without interest rates going up. So the last leg of a decline is typically you shoot the winners and bad news becomes bad news. It's when the economic news and the outlook for earnings is more important than the outlook for interest rates. And I think we're in the beginning of that discovery process now. So I really want to be clear. I really want to be clear, guys. Like, now is not the time. Last year, when they're beginning to jump rates 75 basis point at a clip, to me, that was the time to be, bearish, really bearish. Now the market can go down, but I want to take advantage of it because we are longer into this cycle, especially if lower interest rates, if interest rates come down.
Tony Dwyer, thank you so much for your time and your insights, Tony. That was great.
Happy to be with you. Thanks for having me, guys.
Let's get some tickers now. Shares of the maker of Marlboro cigarettes, Altria Group, sinking today. The tobacco giant cut its full-year profit forecast. Net revenue from smokable products fell 5.3% in its third quarter as smokers search for cheaper brands and other alternatives. So this one, Julie, listen, weaker than expected revenue. I guess the decline I'm seeing in U.S. cigarette shipment volume was disappointing too. Citi was telling its clients, they have a neutral on the name, price target's 45. They talked about the consumer is under pressure. No surprise there. And that is obviously a headwind. They also know the guidance boost fell short of consensus as well. So talking about stock now firmly in red for the year.
Yeah, this is a really interesting tidbit that caught my eye that Barron's flagged today. So, some commentary from the CFO, Sal Mancuso, saying when you talk about customers looking for alternatives, apparently they're looking for illegal alternatives in some cases. No, I'm not talking about the cannabis shops that are all over New York City. Apparently illegal flavored disposable e-cigs are also proving to be competitive with Altria's products, which is quite interesting. Part of what's going on, according to Mancuso on the call, also has to do with economic factors, right? But part of it has to do with these illegal alternatives, which is quite interesting to me that is happening. But you still are looking at sort of a long-term secular decline in, the main, not vapes, but the main product here when we're talking about cigarettes.
Nope, one to watch.
Yeah, definitely. All right, let's talk about another one. That is MasterCard. That stock is also under pressure today. Despite beating analyst expectations in its third quarter, it was boosted by a bump in consumer spending. The payments network did forecast fourth quarter revenue growth that is below analyst expectations, and that appears to be what is responsible for the drop here of 5% in the shares, even though, if you look backwards, the company did quite well. It really has to do with this forecast from the company, even though people were spending last quarter. So it's a little bit confounding here. Low double digits is what it's expecting for the remainder of the year. 14% is what analysts have been predicting.
Yeah, it's the forecast. When you look actually what they reported, to your point, Julie, you're spot on. Volume on its cards beat analyst forecast for Q3. It rose 12% to 1.9 trillion. Consumers are hanging in there, right? Cross-border volumes, that increased about 20%. So that suggests people are still out there. They're traveling, but it's the forecast that's got them down.
Yeah, and it's really interesting, what the card companies are seeing on this front, that they are getting a little bit more cautious going into the fourth quarter.
Yep. Getting Tony Dwyer-like.
Yeah, I know. I was going to say, it kind of gives me that vibe.
All right, moving on here. Last one, more bad stock news. Let's check out Western Digital shares. They are plunging today, yikes, on a report that talks between the company and Japan's Kioxia Holdings have broken down. This comes as South Korea-based SK Hynix, and indirect shareholders said it would not support the merger. So that is what's going on here. We're falling because deal negotiations with Kioxia, that looks to be breaking down. That's putting pressure on hopes of this combination of their flash memory businesses. Bloomberg is reporting that the talks fell through when, as we know, SK Hynix, this indirect shareholder, said, you know what, we're not supporting this deal. We think it's undervaluing our stake. SK Hynix saying it was not agreeing to the deal because of the impact on the value of the company's investment. That's, again, according to Bloomberg citing sources.
Yeah, and, so analysts are now kind of looking at this and saying, well, if there's no deal, then what's the value of this business on a fundamental level? And they're not real sanguine about that. They're showing the one-year chart. If you look at a 5-year chart of the stock, it's kind of a whole lot of nowhere. Yeah. It's had a lot of volatility here. There's the 5 years. It's down to about 13% in that time. You can see it's very volatile because disk drive demand is very cyclical. It's sort of a commodified business, but it seems like investors were really hoping, as they've seen a rebound in the shares this year, for this kind of combination. Yeah,
Bloomberg did report it's possible discussions eventually pick back up. They could resume, but rough day if you're a bull.
Yeah, definitely. All right, we're just getting started here on Yahoo Finance Live. Coming up, big tech on deck. We'll get earnings reports from Amazon and Intel after the bell. We're going to break the numbers and provide in-depth analysis. Also, here it comes. Spooky stocks continue. This time it's shares of Disney. They're down more than 50% over the last 2 years. We will talk about the moves with a top media analyst. And Sam Bankman-Fried taking the stand in his own defense, but not in the presence of a jury. We will talk about the judge's latest move to send the jury home while SBF talks. That's coming up after the break.
2023 rocked the markets.
NVIDIA, the stock has been on a tear.
Silicon Valley Bank's collapse is the second largest bank failure in the U.S.
Inflation,
mortgage rates,
the diabetes drug, Ozempic.
Now it's time to make bold decisions. Yahoo Finance Invest. the marquee event for investors seeking big ideas and bold decisions. Guided by the newsroom you trust. Don't miss it, November 7th, exclusively on Yahoo Finance.
The FTX founder, Sam Bankman-Fried, now testifying in his own defense, but without a jury present. Judge Kaplan sending them home so that he can hear out the testimony in this case and see if any elements will be admissible. In the unusual move of taking the stand, Bankman-Fried has decided to come to his own defense, denying all charges against him of fraud and conspiracy. Sam Enzer has been following the case and is a partner at Cahill, Gordon, and Reindel. So, Sam, welcome to the program. Thanks for joining us.
Thank you for having me, Josh.
And Sam, let me ask you about this news. The judge decides to send the jury home so he can conduct this hearing and see if some of Sam Bankman-Fried's testimony is admissible. And I guess Sam Bankman-Fried then gives the testimony to the judge without the jury present. Sam, I'm just curious, how unusual is that?
It's not done that commonly, but it is something Judge Kaplan has done in the past. I personally, when I was a federal prosecutor in the Southern District of New York, had a trial in front of Judge Kaplan where he actually used this procedure. And so the concept of it is that he will hear a preview of the testimony of the witness, in this case, Sam Bankman-Fried, and that way he will know exactly what the testimony is. He'll have a record of it, and he'll make a ruling on a concrete record as to whether or not pieces of it can come in. And that makes it easier for an appellate court later on, if this case ends in a conviction and goes up on appeal. It makes it easier for the appellate court to see why it is Judge Kaplan did what he did in letting certain things in or certain things not come in.
So obviously we're not inside the courtroom. We don't know, but what would be the difference between what's led, in this particular case, and in as much as, what we know about it, what could be eligible to not be heard by the fuller jury?
Good to see you, Julie, and thank you for having me on. So I think a couple things that we know are controversial and difficult from an evidentiary perspective are Sam Bankman-Fried's intention to testify to the role of lawyers in giving him advice about certain things that the government has argued demonstrate that he acted with criminal intent. So, for example, we heard testimony from the government's cooperating witnesses that Sam Bankman-Fried instructed the employees at FTX to use Signal for communications and to have those communications auto-delete because it would look bad to regulators. Sam Bankman-Fried, in his own defense, wants to say, no, no, no. I talked to lawyers, and they told me it's okay to use Signal for certain things, even if we delete it, as long as there were certain restrictions on it. And that raises complicated issues about, does this waive the attorney-client privilege? Is this testimony accurate, fair, or is it unduly prejudicial? Is it misleading? And so I think Judge Kaplan wants to hear it and know exactly what it is that Sam Bankman-Fried will say about it before he decides whether that is something appropriate for the jury to consider.
And Sam, I'm just curious, if you were Sam Bankman-Fried's attorney, would you have advised him to take the stand to testify?
No. I think it is as close to inevitable as you can get that he will be convicted in this case. I've been following it closely. I think the evidence is overwhelming. And so I think he's going down either way. But testifying and getting convicted despite that testimony risks the judge determining that he has perjured himself, which can add to his sentence when it comes time for sentencing. In addition, I think that there is a lot of evidence that would not have come in that he will now open the door to on cross-examination. Prior bad acts, statements he's made that are inconsistent with what he's going to say here. So I think he's going to hurt himself by doing this.
Is there any upside to him testifying?
There's a possible upside. It's a Hail Mary. So if Sam Bankman-Fried, if you believe the government's case, perpetrated a massive fraud. So obviously, he's somebody who can be charismatic and persuasive. He persuaded a lot of people to give him billions of dollars. And so perhaps he thinks, I can persuade these 12 people in the jury box that I'm innocent. And if you're going to lose and you're going to do decades in prison either way, maybe you take the shot at the Hail Mary and you don't worry about whether it tacks on a few extra years to your sentence because it gives you at least some hope of getting off.
And Sam, if he is convicted here, would you expect, an immediate appeal here by Sam Bankman-Fried's team? And is there anything they could argue on appeal that you think would have an impact?
So the way criminal cases in federal court go, the case, you cannot appeal in the middle of the case. So they have to first wait for there to be a sentencing. And then once the case is over and there's a final judgment, at that point, the defense can appeal. I expect that if Sam Bankman-Fried is convicted and sentenced, that he will appeal. I think there are some arguments he can make about evidence that wasn't allowed in, certain things that have happened at the trial, but I have not seen anything that I would call reversible error, the type of error at a trial that would justify a new trial or throwing out his conviction.
Sam, finally, we've been talking to a lot of attorneys about this case. A lot of people are watching it closely. We're watching it closely because it's an amazing story, obviously, what has happened with Sam Bankman-Fried. I'm also curious just from a legal perspective. Your community, the legal community, seems to be very interested in it as well. Is there something about this particular case? Is it just that, like us, it's a fascinating story? Is there something from a legal perspective that's also really fascinating here? What do you think?
It's always fascinating to see a fraud. There's a reason why we all have Netflix and watch true crime series. But I think apart from that, I'm the head of the cryptocurrency and fintech practice at Cahill. And FTX was intertwined with many other parts of the digital asset ecosystem. So there's a lot of things that come out during the trial that are relevant for other players in the space, including many of my clients. And so we have to watch it closely to see how the testimony will affect those clients in the aftermath of this case.
That makes a lot of sense. Sam, happy watching, I guess. Happy if you can call it that in this case. Anyway, we'll all continue to watch it together. Sam Menzer, thank you so much for your perspective and expertise on this.
Thanks for having me. It was a pleasure.
Pharmaceutical giant Eisai says an injectable version of the Alzheimer's drug Leqembi is showing positive results in clinical trials. The new therapy clearing 14% more of the specific plaques found in the brains of people who have Alzheimer's than the currently approved drug, which is administered through an IV. Eisai sells the drugs in partnership with Biogen, and Yahoo Finance's Anjali Kamlani is here with more. So, put this in perspective for us, this report.
Yeah, Julie, of course. So this, of course, opens the door of a broader conversation about access to this drug. That's really what the main focus of this report is, with similar results to the infused version, the infusion version of the drug. What Eisai and Biogen are saying with this report is, rather than just being stuck to a hospital atmosphere and covered by Medicare Part B, this opens the door to Part D coverage, and also for more locations where patients could, for example, self-administer the drug at home. And we know that is something that is increasingly popular because we've seen that with weight loss drugs and diabetes drugs. So it really falls into that category of more patients, more potential outlets and access points for this drug. Of course, the side effects are still a concern, and that is likely not to change, according to a conversation that I had with an Eisai executive earlier. There still will be the normal routine follow-up every couple of weeks, but the idea that patients won't necessarily have to be stuck in the hospital once every 2 weeks could free up and open the door for more of those patients. And I spoke to Alex Scott, who's a VP at Eisai, and had a little chat about, what this really means for the drug, how things are going with the current infusion version. There was supposed to be slow uptake as a result of sort of caution over the previous Aduhelm, which we saw, having some concerning effects and concerning costs. And he told me that actually the formularies have been quick to take up and approve this infused version. In fact, faster than what they had anticipated. And they're actually starting to see new ways of treatment and new sort of models coming up that help put treatment for this and patients at the center with, say, a neurologist, an infusion chair, and MRI monitoring all in one place rather than dedicated to the separate departments than they already exist in. So it's a fascinating sort of story right now for Eisai and Biogen coming out of that Aduhelm saga and seeing a little bit more maybe enthusiasm around this new drug.
And Anjali, Pfizer and BioNTech out with good news on the vaccine front today. What did we learn there?
That's right. An early stage trial showed that there was at least good tolerance, a good safety profile for their combination flu and COVID vaccine, And that's good news because now we're going to start seeing old foes back again in a race with Moderna as well as Novavax and a couple others pursuing this combination vaccine, ideally, so that we as patients and individuals don't have to get 3 or 2 shots every year. There are also RSV plus COVID plus flu combination vaccines in the works. So this is just part of this growing portfolio of addressing respiratory viruses so that maybe flu season isn't so bad for flu season. And now we know, of course, with COVID. So good news out there. Still have to wait to see how they get to the finish line with phase 3 and what the FDA has to say about all that.
All right, Anjali Kamlani, thank you so much. And Overstock reporting mixed third quarter results today following the purchase of parts of Bed Bath & Beyond earlier in the year. We're going to break down the report with the CEO next. Bearish signals abound on Wall Street, especially as the S&P 500 nears correction territory. Jared Blickery has a closer look at what you should be on the lookout for. Jared, this sounds spooky.
Yeah, a little bit, Josh. Let's go to the Wi-Fi Interactive. The Nasdaq went into correction territory only yesterday, and here we're looking at the S&P 500 over the last 3 months. Let me just put a 200-day moving average so you can see it now has punctured. It came up, it tested the breakdown level, and now it is definitively closed or is about to close pretty far down. So that is a negative signal. It's also about, 0.5%, 1% away from closing down in correction territory. We almost got to that level earlier, but it's measured on a close-to-close basis, so probably not going to hit it today. And then there's the Russell 2000, and I was writing about this in the morning brief. Let me show you a 5-year chart so you can see it is just flirting with the lowest levels here since Biden was elected. That is just a huge give back of one of the signature pandemic era trades. And then when you delve into the NASDAQ 100 and some of these big mega cap stocks that we look at, the sectors are under pressure. Now, this is today's price action. Real estate is in the top seat here. For the week, as of Thursday, utilities, those are up 3.3%. Real estate and staples are also in the green. That is a very defensive setup here. Communication services, which houses both Meta platforms as well as Alphabet, that is the biggest loser here. Energy is also a loser for many different reasons. And then when we look at the month-to-date totals for October, only utilities, a very defensive sector, is in the green, and that's followed by staples, tech, and healthcare. Those are the least bad in this sector group. And then the worst, that is consumer discretionary, followed by materials. Those are very cyclical sectors there. Now, I'm going to show you what's happening with Apple. This is a month-to-date basis on the NASDAQ 100, but I want to punch up Apple here. We've been talking a lot about 200-day moving averages, not shown here. Apple just sliced below its after trying to hold this September support and failing. You take a look at the year-to-date chart, arguably at the bottom end of a downtrend channel, so could see a little bit of a relief, a little pop tomorrow, but longer term, we're still in a downtrend there on a short-term basis. And then finally, taking a look at Meta, this is closing in on the lows of its 2-month range here, so another stock that's just under pressure, although at least it is not as far off of the 52-week highs as some of the other stocks, guys.
Indeed, Jared. So not ending on a less spooky note, maybe less scary note.
Yeah,
Thanks so much, Jared. Appreciate
we'll run
it.
with that.
Yes. Well, Overstock reporting mixed third-quarter results today following the purchase of parts of Bed Bath & Beyond earlier in the year. The company, by the way, announcing this week it will rebrand. It will become Beyond Inc. Revenue, by the way, did not meet the street's predictions, but the losses did come in smaller than expected. Joining us now, Overstock CEO Jonathan Johnson. Great to see you, Jonathan, as always. Talk about the quarter and the integration here. I want to start with kind of, if you could, a bit of an explainer, because you all reported that revenue fell 19% year over year. The acquisition of the Bed Bath & Beyond assets, and more importantly, the rollout of the brand in the U.S. as part of Overstock happened later in the quarter. So talk to us about the cadence then and how that decline kind of factored in as the quarter went on.
Well, we did miss the top line, but there were a lot of things that we really liked about the launch. One, it happened quickly within 33 days after the acquisition. And two, that we saw an increase in active customers of nearly 300,000. These are people that hadn't shopped with us in over 12 months or had never shopped with us that came to shop. August was great. The launch was really strong, followed by September's Labor Day, which was strong. Historically, the end of September is usually a little slower, and we saw that too. We do think we're in a good position to capitalize on the upcoming holidays. We have an exciting new national branding campaign that we'll be launching next week. So we're very confident that with this rebrand, the holidays will be better to us than they've been in the past.
Yeah, I'm interested, Jonathan, just to dig into more of your outlook for the holidays that you mentioned there, because as we all know, consumers are facing some challenges here, rising energy prices, higher borrowing costs. What do you see coming up here in the holiday season?
Well, I think the holidays are going to be highly promotional. I think they'll be challenging. As we've added over 2 million product SKUs to the site since the announcement of this deal. Those are really across good, better, and best product categories. We do see people trading down some, and we have the product to give them. We're going to be bringing back the 20% off coupon, and as part of our national branding campaign. We know that as people spend at the holidays, they'll be trying to stretch their dollar this year a little bit more than they have in the past. And we think we're good at that. And we think Bed Bath & Beyond is a brand that they're used to coming and purchasing gifts, and they're used to coming to purchase tabletop and other decor that they use when they host for the holidays.
So, Jonathan, we've talked about this a little bit in the past, what buying these assets have done for you guys. Does it also diversify you away from being overly reliant on home, right? If you're going to lean into the gift-giving aspect for the holidays, we've been talking almost on a daily basis about the sort of freeze in the housing market. How are you viewing that market right now?
Yeah, I think for the fourth quarter, we'll be better than we have in the past because of the gift giving. Home is not particularly a strong fourth quarter category historically, but with more giftables, we think it will be stronger for us. Another thing we talked about on our earnings call today, and it's part of our renaming the corporation Beyond, is that we can go beyond being just a single site retailer. We plan to, in the next 12 to 15 months, reimagine the Overstock site, stand it up not as a competitor to Bed Bath & Beyond, but as a cross-category Overstock branded clearance and liquidation site, going back to our roots of almost 25 years ago. So we are looking at ways to become less affected by swings in portions of the economy. And, high interest rates, low housing sales, they certainly have made it tougher from a macro perspective for our industry.
And does sort of that return to your roots, if you will, with a reimagined Overstock.com, does that also lean into maybe some anticipated economic weakness as well and people looking for bargains more than ever?
If we go back to how we began, periods of high beta were good for the clearance and liquidation business that we started 25 years ago. I foresee that continuing. Good times, bad times, they're always, when times of high beta is when manufacturers and retailers have inventory adjustments they need to make. That's what liquidation's all about. That's in our future, but we're most excited about what's in our immediate future with the holiday season. We're starting a new brand campaign. I think it's going to be an exciting time for us.
And Jonathan, from my understanding, you're also looking for a chief marketing officer. I'm just curious how that search is going and when you all think you'll be able to fill that role.
Search is going well. There are a lot of very qualified candidates who are interested in being part of the iconic brand that Bed Bath & Beyond is. We know that there are a lot of great candidates who right now are interested in us, but are focused on delivering for their current employer in Q4. We're heads down, delivering Q4 too. I suspect it will be kind of after the shipping cutoff that we'll start bringing some of these qualified candidates in for more panel interviews. I suspect it'll be mid Q1 where we'll have a really qualified chief marketing officer in seat.
Jonathan Johnson, thank you so much, sir, for joining us today.
Thank you, Josh, Julie.
And coming up, spooky stocks. Disney is down around 12% since the return of Bob Iger nearly a year ago. What could turn the ship around for the Magic Kingdom? That is coming up next. A week ahead of Halloween, we're looking at stocks that have spooked investors of late. Today, we'll be taking a look at Disney. Yahoo Finance's Alexandra Canal has the details.
Hi, Josh. Well, you don't need me to tell you that the Magic Kingdom is in disarray. You can just take a look at the stock price. Shares of Disney down over 50% over the past 2 years and down around 12% since the return of Bob Iger nearly 1 year ago. Iger served as Disney CEO from 2005 to 2020, and he handpicked Bob Chapek as his successor. But Chapek's nearly 2-year reign was a challenging one. Disney's parks business was clobbered during the pandemic, and in Chapek's final quarter, the company posted revenue and earnings that missed expectations, while its direct-to-consumer streaming segment saw a whopping $1.5 billion loss. And then, less than 2 weeks after that disastrous report, Iger was back in that coveted CEO seat. But his surprise return has not brought back the magic that shareholders had initially expected, with Disney still facing some key challenges like a decline in the traditional TV business, the possible sale of linear assets like ABC, and cable channels like FX, Freeform, and National Geographic. We've also seen weak subscriber numbers for streaming, coupled with a tough advertising environment and slowing demand for its parks business. And then, of course, the overarching question of succession, as Disney is still trying to launch new initiatives like an ESPN direct-to-consumer platform. So there are clearly so many unique challenges for this company. Activist investor Nelson Peltz recently launched a renewed attack on the media giant amid some of these hurdles, but there has been some optimism on the street. The stock currently has 30 buy ratings, 8 holds, and 2 sells.
Thanks, Allie. And stick around here because next up we're going to be talking to, for more on Disney and a possible investment case, we turn to Jessica Ehrlich, Bank of America Securities Senior U.S. Media and Entertainment Analyst and Yahoo Finance's Alexandra Canal. So, Jessica, let me ask you this. The stock is down now about 10% year to date. Do you think, Jessica, the risks, the challenges that Allie just laid out there, is it priced in at these levels?
Yeah, I do think a lot of it's priced in. Allie mentions a lot, but there's even more that she could have mentioned. There are a lot of challenges. They just came out of the battle with Charter, which lasted 11 days. I think the end results was actually a positive for Disney. Their film division has performed extremely poorly after, many years, more than a decade of incredible industry-leading performance. They also have, which may tie into some of the linear issues, ESPN searching for strategic partners. But I think that Allie got a lot of the issues that have been hounding Disney for the last 2 years.
So Jessica, given all of those...
I'm sorry, go ahead. Go ahead, Allie.
No,
go ahead.
I was going to say, Jessica, given all of those challenges, what one in particular do you think is dragging down the stock price so much?
Probably, I don't know. I mean, they also remember they have this, I don't want to say disagreement. They have the Hulu put coming up, so they have to pay at least $9.2 billion, maybe more, for Comcast 1/3 stake. I just think it's a combination. India has been problematic. But as you look forward, there are a lot of things that will change in the year ahead. fiscal 24 for them. So I don't know that it's one thing. It's just been one thing after another.
And Jessica, Bob Iger, grade his performance for me since his return. What letter would you give him? And it's only supposed to be, a couple of years, right, Jessica? So what are succession plans here as well?
It's because of the secular and cyclical challenges. It's a little hard to put a grade on Bob because the entire industry is suffering. I mean, there are some self-inflicted issues that may have been caused before Bob got there, whether the film division, it needs a lot of tender loving care, which I think is his priority at the moment. But you can't blame Bob for the ad recession that's going on across the industry, nor the decline in the linear pay TV universe. So some of this stuff is just, it is what it is. And I think there's a lot of confidence that Bob can do it. On the succession issue, I don't even think this is the right time to talk about that because there's so much to do to kind of get the company into the right place. They've restructured. They're bringing down costs. They're fixing what seems to be fixable. The focus now is on improving the content engine that it was and has been. But there's a lot of work to be done. They don't even have a CFO, a permanent CFO. So, Bob needs these extra 2 years. That's, I think, and Disney does too. There's no obvious candidate. But there, again, I would say there is some optimism as you look at for the year ahead. There are several things that will change for the better.
And Jessica, you mentioned one of those near-term priorities is finding those strategic partners for ESPN. Given the fact that we just saw ESPN's financials, who do you think could be best suited for that position? And I'm also curious to get your thoughts on that ESPN breakout, since we will receive some of those updated numbers in 2 weeks.
So ESPN's EBIT OI is, just under $3 billion. And it's a challenge. It's a challenge to grow that in the face of declining subscriber universe. So they will get price increases. So their agreement with Charter had that dispute where they were off the air for 11 days. Our understanding is that there's a healthy price for affiliate fee increase, and also that Disney Plus will be included probably early 2024. And that will give Disney Plus at least 5 million incremental subs in our. The strategic part is that I'll tell you the industry speculation has been that there will be investors coming in, including possibly some of the major sports leagues, maybe technology company, maybe distribution, but it's not clear what anybody gets from a minority stake. So we'll just have to see how that develops. But that is one of the I would say the challenges at the moment. Resolving Hulu and getting that is another issue. Maybe selling India, which has been a real drag in a very different market than anything else they operate in, will also be a priority.
And Jessica, let's talk about parks too, because Disney has said, listen, they're going to invest $60 billion in parks and cruises. Is that a smart strategy in your opinion?
Well, it's a slow ramp. So it's $60 billion, which is double what the last 10 years were. But you can see that there are investments that the money will ramp as the new cruise ships come online, as the new attractions come online. But they've always said, for decades, that theme parks in general and these major attractions are their highest return on invested capital. So the demand for theme parks for them, for Comcast with and the Universal parks, it seems insatiable, maybe a little bit too extreme, but the demand is really incredibly strong on a global basis. And I think that we really should just at least mention that direct to consumer, this year's peak losses, and the company has said over and over, they've reiterated that they expect to get to profitability before the end of fiscal 24. So in the coming year, the coming fiscal year, they're in a September fiscal year, there should be a really big swing in profits from DTC, which is a combination of cutting costs, increasing price, introducing the advertising tier, which will have a full year. So there are things that we can look for, and hopefully the ad market will improve as well.
So Jessica, narrowing in on that earnings report November 8th, what's the one thing you're looking for? What do you think will boost some optimism in this company?
We've already heard from a number of companies this week, so we know that it's not going to be a turn in the ed market. But what they say in terms of the profitability for DTC, how quickly they can actually cut costs, what they say just kind of the outlook, the bookings for theme parks always is of interest. I think the film part of the business, the creativity, that's a slower build. I'd be really surprised if they have an ESPN strategic solution in 2 weeks. That could be a surprise.
Jessica Ehrlich, thank you so much for your time today, and our thanks to Ali Canal as well. And coming up, the closing bell on Wall Street, we're going to be checking in on the latest market moves and the top trending tickers. Stay tuned.
Welcome back to Yahoo Finance Live. You are watching the closing bell on Wall Street and just taking a look at some of the settling prices here as they move into that final number of the day. We have the Dow down 251 points. That's 0.75%. The S&P 500 in the middle down about 1.2%. And the Nasdaq, another day of losses, down 1.76%. Looking at a chart on the Wi-Fi Interactive over the last 2 days shows that the Nasdaq down 4.14% and just off the lows there from earlier in the day. Now, let's take a look at the sector action, and we can see utilities and real estate, those have been a stalwart of the market all day. Also materials in the green there, but most of the sectors in the red. And the one taking it on the chin the most, that is communication services. That's down 2%. That houses both Alphabet and Meta. Both of those recently released their earnings, and we've been talking about some of the negative price action, especially in some of those majors. Tech also taking a down draft, and then consumer discretionary. So all in all, mega caps were really the story of the day. And just look at that left side of this heat map here. That is all red and dark red. NVIDIA also down 3.5%. Microsoft another 3.75%. And if we're to flash to a 4-day total, Only Microsoft is is one of the mega caps that's in the green there. Now let's go to some other sectors of the market. This is our leaders and sentiment indicators. Guess what? Crypto over the last 4 days, that's green. But today we're taking a look at regional banks. That is our #1 performing industry here. That is up 3%, followed by solar. Home builders also are getting some love, but to the downside, cannabis and New York FANG, that is a lot of those mega caps that we've been talking about. Those are down the most. So is crypto. Bito, that is a crypto ETF that features Bitcoin. That is down 2.5%. Now, taking a look at some of the automakers, we were talking about the UAW strike potentially getting resolved, if not today, then over the weekend. Ford down 1.5%, so is GM, but Tesla really taking the show today. That is down 3.14%, and there is a look at the intraday price action. Here's a look at year to date. You can see still up 67%, but now in the middle of its trading range. Also taking a look at some of the other sectors here, we got China and energy. You just saw China green, energy red. I'm going to do banking sector real quick. Banking ending on a positive note for the most part. I'm sending it back to you guys.
Thanks so much, Jared. Really appreciate it. Sorry, distracted momentarily looking at Amazon's numbers. Amazon is out with its earnings here. It looks like third quarter net sales coming in ahead of estimates, $143.08 billion. That's versus the average analyst estimate of $141.56 billion. However, the fourth quarter forecast leaves a little room for it to miss estimates. If you take the company's fourth quarter net sales forecast, it's $160 to $167 billion. Analysts have been looking for about the upper end of that, around 167. So leaving some room to miss, but not really hurting the shares at this point. They're up by 5.5%. Something else that Josh and I were both watching very, very closely, the AWS, Amazon Web Services sales, $23.06 billion. That is slightly below the $23.13 billion estimate. I guess you could see that potentially as in line with estimates. Excluding currency effects, AWS sales up 12% versus an estimate for a gain of up 12.4%. Other bright spots here, though, include the fact that operating margin came out well ahead of estimates overall for the company in the third quarter, 7.8%. That's above the 5.5% that analysts had been estimating here. So on balance, looking backward, quite a strong quarter on a number of different metrics for the company, even if AWS was a little bit light here. But the share's trading higher, Josh.
Yeah, sharply higher. At least the initial reaction here. We're up 5% in the after hours. Margins beating there, Julie, as you noted. And the reason we concentrate so much on AWS, the cloud computing business, is that is this company's profit center. And remember, investors have gotten used to, for a long time, seeing like 30% plus growth rates in that business, and then really decelerated. The last time we heard from Amazon, they said Amazon was growing, the AWS segment was growing around a 12% clip. This time, as you noted, again, we're looking at net sales ex-FX plus 12%. As you noted, that's basically in line with where the street was at. Estimates were 12.4%. It'll be really interesting to hear more from executives about what is the trajectory of AWS from here. What does it look like? What does cloud spending and consumption look like as we head down to 2024?
Yeah, and it's interesting that we're coming off a couple of days where you had an Alphabet that had a cloud number that didn't necessarily match expectations, and the stock dropped sharply. Now, Amazon was down about 1.5% in today's session. It's been down in the 5 days leading up to this report, up strongly on the year. So, in other words, it's not as though expectations were that dismal going into this. They seem to have been a little bit depressed. So it's interesting that we are seeing, indeed, some quite positive performance here and quite positive reaction to these numbers. I'm still waiting, by the way, for the actual release to come out on their website. I haven't seen that as of yet to get a little bit more of the color commentary.
Waiting. Obviously, some other trends we want to hear a lot more about from the company is going to be what they're seeing in terms of holiday spending, the e-commerce segment. How do they see it shaping up over the quarters ahead? I think there'll be questions for sure, maybe about the regulatory challenges, the FTC suing Amazon, alleging illegal online marketplace monopoly. It didn't seem like investors were too concerned for that. In fact, we had analysts on Yahoo Finance, Julie, who argued that worst case scenario, if they got broken up, it actually could be worth more, but you could expect
Right.
that question to come up. I think competition will be really interesting too, especially from the Chinese entrants, Temu, Shein, TikTok Shop even. How do they think about that dynamic as well will be interesting.
Yes, most definitely. And just a couple of the other things that the company talked about. It talked about its physical store sales, right, which is basically it's some Amazon branded stores, but mostly Whole Foods, right? Physical store sales, $4.96 billion. That's about in line with what analysts had been anticipating too. That's always something that I pay attention to because I'm fascinated by their acquisition of Whole Foods. Have the release now and just kind of scrolling through the company talking about some of its highlights, how much it sold during Prime Day, the various other shows that it has on Amazon Prime as well. So, kind of highlighting those various elements from the company. All right, let's get more on all of this. Nick Jones, Citizens JMP Securities equity research analyst who covers Amazon. So, Nick, what's your sort of first blush reaction here to these numbers?
3Q numbers look really solid. I think there was a lot of concerns around AWS maybe being a little weaker heading into the quarter. Google maybe didn't perform as well. Microsoft did better. That left a question mark for AWS. So I think AWS looks good. The operating income margins look really good. So I think that's why we're seeing the stock move upward after hours here.
And what are the puts and takes, Nick, in those margins, do you think?
There's various headlines. They're doing some extra hiring for the holiday season, which I think spooked investors of like, wait a minute, our margins are going to get compressed. Then you see other headlines that maybe they're being a little more prudent in different departments. So I think they have focused on cost control, and they're really utilizing their infrastructure. The advertising business continues to outperform and do better than expected, which delivers a lot of margin upside as well. So I think they're kind of pulling all the various levers they have across their business units to kind of give investors what they're looking for, which is better operating income margins.
What about cloud, though? What about AWS, which seems to have, it didn't blow away estimates, certainly. Maybe was a little light of what some were looking for there. And we saw a similar situation with Alphabet that caused the stock to go down. What's the difference between that and this situation?
So in the conversations we had heading into the quarter, the expectation was AWS might be 10 to 11%. They ended up delivering around 12-ish. So I think better than what investors were kind of fearing heading into the quarter. Really, focus is going to turn to what is the commentary about 4Q, and is the business stable, improving, worsening? That's what we're all going to look for on the call later.
And Nick, what about these regulatory challenges as well? Obviously, you made a lot of headlines. The FTC is going after Amazon here, alleging illegal online marketplace monopoly. How concerned should investors be about that, Nick?
I don't think they should be very concerned at all. We don't see any of Amazon's practices as illegal, kind of whatsoever, without going to a long-winded explanation as to why. But a lot of things are being accused of have been practices by Walmart, Target, grocery stores, kind of every retailer for a long time now. So we think that's overdone. We don't think that's really even baked into the price today.
What do you think in terms of, we have heard some retailers start to talk about a change in consumer spending patterns, right? Particularly among lower income consumers. What is the effect on an Amazon from something like that, if any?
Yeah, I thought that's why we like Amazon. We think there's very little effect to Amazon. They have very compelling prices. They have a huge selection. They have pretty much an unbeatable consumer experience for their retail product. So we don't see a huge impact on Amazon here. And while broader retail is showing some signs of weakness, e-commerce continues to keep gaining share. And Amazon's a great destination with Prime Day, their early kind of holiday sale, to go find great deals and get the stuff fast.
All right. Nick Jones, obviously a fan of the stock here. Nick Jones, thanks so much for giving us some instant reaction there on Amazon. Really appreciate it. All right, let's get to Intel. Those earnings are out as well, and Intel beating estimates. Now, here you could definitely argue that expectations were depressed going into Intel's numbers. The company beating on earnings per share, 44 cents a share is what the company is reporting versus the 31 cents that analysts had been anticipating. And here it is the forecast as well that gets our attention. The company's forecast 14.6 to $15.6 billion for revenue. That is versus about $14.4 billion estimated by analysts. In other words, that fourth quarter revenue forecast pretty comfortably above what analysts had been predicting. Intel has really been fighting this perception and reality that it has been behind the curve. And Pat Gelsinger, the CEO, has really been fighting against that hard, talking about building out new fabrication, bringing fab back to Intel, right? And building out a lot of the company's capabilities. And the street has not necessarily been convinced. The results have been a little bit uneven. So this showing a little bit more consistency on that front. Talking about some of the different business lines here, the company's data center and AI revenue at $3.8 billion. That does look to be slightly below what analysts were anticipating. Client computing revenue, though, at $7.9 billion versus the $7.4 billion estimated. You mentioned this yesterday, Josh, when we were talking to Qualcomm's Cristiano Amon about this just sort of domination in enterprise that Intel still has. And I think the client computing results probably indicate that to some extent.
Yeah, so I'm looking through the segments as well. So client computing, so chips for PCs, that was a beat. 7.87 billion. The street was around 7.35 billion. Data center and AI revenue, that looks like it came in a little bit lighter, 3.8 versus 3.94. Of course, investors really pay attention to that because those are higher margin chips. There's a few different moving parts here for Intel. I think analysts will say the PC market, they'll know, does seem to be perhaps bottoming and normalizing. That's good news for Intel, though we've also been talking a lot this week about how there's a lot of new competition in that market, including from Qualcomm. We heard from Qualcomm's CEO. Other important areas I do want to ask analysts about: the foundry business. So obviously, Pat Gelsinger has moved hard into there, meaning making chips for others. And the AI story, how important that, how much of an opportunity is that? Bernstein's Stacy Rasgon, friend of Yahoo Finance, telling his clients he thinks the AI effort there at Intel is still incremental at best at his point. So he's a market performer, he has a hold, but those are some of the threads I think investors are going to want to hear from Pat Gelsinger on the call.
Yeah, and I should point out that even though these various business lines did beat estimates, it looks like by and large, right, and revenue beat estimates, was still down. Revenue is still down year over year. This fourth quarter forecast does represent a rebound in revenue, looking for an 8% year over year gain in revenue with that forecast range that they have given. For the fourth quarter, they're also looking for an increase in gross margin to 46.5%. So that's something to keep an eye on as well here when we look for what is sort of coming back, what a comeback looks like for the company and where they are making these improvements. The shares are up about 23% year to date. So it's, there is some optimism baked in here. But like I said, it's been uneven. It's been in fits and starts. So it looks like investors encouraged by this latest report.
It's interesting because you talk to analysts. I think I've heard a lot of analysts, I think it's fair to say, who they may not disagree with actually Gelsinger's strategy for the company. I think there are questions about, it's a big turnaround plan. Can he stick the landing? I think is what
Can he stick the landing, and will the street give them enough patience to, because it's going to take time. It's not a matter of, is it not a good path? It's just a matter of how long it's going to take when others are perhaps already out ahead of the company. All right, there's one more company we got to talk about that just came out with its numbers, and that is Ford. Ford coming out missing analyst estimates here. The share's down 5%. Earnings per share from Ford at 39 cents versus the 47 cents that analysts had been anticipating here. And unsurprisingly, perhaps, the company's withdrawing its full-year guidance. That's because of what's been going on with the strike and the difficulty in predicting that. Of course, as we learned today, Ford and the United Auto Workers do have a tentative agreement. We don't know the full details of that yet. The UAW has released some of that, also among other things, talking about a 25% increase to pay for union workers over the next several years. But until that's ratified, because it's still subject to ratification, we don't know exactly the effect that's going to have on Ford. So withdrawing its forecast as we await that. So still looking through some of these numbers here, but that's what stands out to me out of the gate.
Yeah, that deal, I mean, listen, 25% pay hike over 4.5 years, 30% if you factor in the cost of living adjustments. How much that is going to cost Ford? You know, the team at Wells Fargo put pencil to paper. By their math, they think it's probably going to be about $2 billion. As you noted, though, Juliet, that deal still needs to be ratified by rank and file. Analysts I know think that could probably take 1 to 2 weeks, perhaps. And then, of course, also GM and Stellantis, those talks continue. Does a Ford deal sort of help a deal get done there as well? And if so, I mean, listen, you know Sean Fain is going to keep pushing them very hard. Wedbush analyst Dan Ives was betting that a deal between the union, GM, and Stellantis, he thinks likely gets done over the next week. We'll see.
Just looking in the release and some of the other details here, third quarter revenue at Ford did rise by 11% to $44 billion. That's the year-over-year increase here for the company. And it's also talking about the various business lines for the company. So Ford Pro, which is serves commercial customers there. The company talked about 12% margins on that business, $13.8 billion in revenue. So up 16% for the Ford Pro business. Ford Blue, which has gas and hybrid vehicles, had, just scanning here for the revenue, having trouble finding the revenue for that one. They're burying it a little bit. But that company, I believe, came out with revenue that was ahead of estimates, perhaps. I'm going to keep on looking through here because I'm losing my place.
All right, you keep looking. I'm going to tease the next one.
Okay, do it up.
Coming up, we are going to dig into Intel earnings report. That is coming up next. Stay tuned. Intel shares jumping on earnings, and joining us now is Matt Bryson, Wedbush Securities Equity Research Analyst. Matt, great to see you. Looking at the reaction here, at least initially in the after hours, investors clearly like what they see. We're up nearly 7%. Let me get your take on the print, Matt. What did you think?
Yeah, they gave us a better revenue result than expected. They gave us a better guide. A lot of it comes down to that PC business getting better in Q3, and I would anticipate that that's what's also driving the upside in Q4.
I mean, this would be quite a rebound for the company, right? I was just looking at the numbers. This would be the first revenue gain, the fourth quarter gain that they're forecasting, going back to the second quarter of 2020. So, is that underlying demand for PCs that is increasing? Is it something that Intel specifically is doing right? I mean, how do we sort of suss that out?
Yeah, so I think a lot of it is underlying demand for PCs. So post-COVID, everyone bought, or during COVID, everyone bought a new PC. We saw a pause post-COVID as inventories got worked down throughout the supply chain. Now I think that the industry is finally seeing a little bit of a bump there. Around Intel, in terms of Intel execution, I think they've executed better on that PC side of things. So I think things are going well there. Having said that, really for Intel to become the Intel of old, they have to get their manufacturing right. That's something that's going to play out in 2024, 2025. So still not a whole lot of insight into whether that's something that works for them or whether they continue to struggle with execution on that front.
And Matt, as we talk about the PC market, you can see competition really heating up. We had Qualcomm CEO Cristiano Amon on the show this week, and he has his new ARM-based PC chip. He's making very bold claims, Matt, about he can beat Apple, he can beat Intel. Then Apple also has an event next week, a Mac event. Who knows? They may come out and tout their own new faster chips. What does all this competition mean for Intel? If you're committing capital to Intel, are you worried about that, Matt? Are you worried about that rivalry?
I think you've got to be worried. ARM has struggled historically to get traction. So the promise had been better power usage, lower cost. That really didn't catch on with consumers. Now Qualcomm's out there talking about a chip that has better performance, uses less power. Supposedly we've got NVIDIA and AMD on the horizon with similar efforts. So it's something you've got to be concerned about. Having said that, if Intel can become the leader in manufacturing again, a lot of that doesn't matter. So whether it's an Intel chip, whether it's an NVIDIA chip fabbed on Intel or a Qualcomm chip fabbed on Intel, if you're the manufacturing leader, as TSM has illustrated, there are paths to grow revenue and to grow revenue profitably. So at the end of the day, I think for Intel, it still comes down to manufacturing. And if you're betting on Intel beyond just a quarter or two, you're betting on the fact that they can get their manufacturing process right.
And what's your confidence level that they can?
So that's a good question. Really, they're still on the same 7-nanometer node that they've been working on for a long time, and which caused them so much trouble. It's their next set of products. So Meteor Lake on the PC side, that's getting released in December. It's things like Emerald Rapids and Sierra Forest that are coming out late this year, early next year, that are going to tell you whether or not they're executing well. And so I think it's very much a to be determined item. I mean, they are saying all the right things in terms of talking about hitting all their milestones in getting these products out. But from my perspective, until you have these products in the hands of customers and things are working well, it's a bit of a black hole, if you will, in terms of information.
And Matt, let me just drill down into this segment with you, the data center and AI business segment. Investors focus on that, higher margin chips. What do you think the trajectory of that segment looks like, Matt, over the next few quarters?
Yeah, so I think it's a little bit of a struggle until mid-year of next year. I think you've got Intel and everyone else who are struggling to catch NVIDIA on the AI side. I think if there's a second player there, it's more likely AMD. You've got customers who are spending more on AI and so aren't buying as many standard servers. And then you've got AMD, who I think is making inroads at the CSPs, the cloud service providers, which you don't necessarily see this quarter or last quarter, in part because those guys are mostly spending on AI. But I think as we move forward through 2024, you're going to see AMD take more share there. And so again, for Intel, is if you get your manufacturing right, your server products are going to hit on time and you're going to get more competitive. But again, that's a to be determined item. The one thing that is a tiny bit encouraging is that NEX segment. So switching, if you will, that segment has grown for the first time in a couple quarters. Maybe that signals the bottom there.
All right, Matt Bryson, great to see you, and thank you for joining us.
Thank you so much.
And coming up next, Royal Caribbean shares edging higher on earnings as it sees continued demand for cruises. CEO Jason Liberty is next.
Shares of Royal Caribbean ended the day higher after the cruise line reported better than expected third quarter earnings and raised its full year guidance. I spoke with Royal Caribbean Cruises CEO Jason Liberty on where the optimism about demand is coming from.
First, it's really great to be here, and I am actually on a ship. It's not just behind me. So, I would say the optimism, comes from a lot of different things. I think first and foremost, we have about 130,000 guests sailing with us today. And we have that each and every day, and we have we have millions of interactions with our guests each and every day, whether it's via web, whether it's them booking directly with us, whether it's coming through our wonderful travel agency community. So we're seeing a very healthy consumer, especially our consumer, where the average income is at least average household income is at least $125,000. We're seeing that consumer not only make very strong bookings today, but they're booking 6, 12, 18, 24 months out. So we have that visibility on how they're trading each day, and they're not only are the volumes above what we have expected and what we have been seeing, but they're at better pricing. So you combine that with the incredible onboard spending behavior that we're seeing, that's what kind of fuels that optimism. But it all feeds into our general formula. Moderate yield growth, moderate capacity growth, good cost control leads to margin expansion, high returns, and step changes in our earnings.
And you mentioned pricing as well, and you also mentioned the amount that people are spending on the ships, which you mentioned has been really increasing and has been a pleasant surprise for you guys. What do you see in terms of pricing trends, not just on board, but for the trips themselves going into the next year?
Yeah, so we continue to see elevated pricing, or pricing continuing to increase as we go into next year. And of course, we're also seeing increases in onboard spend. One of the things that we've gotten a lot better at is being able to get our guests to plan their activities and book their activities well in advance of them getting on the ship. We kind of give them a day back of their vacation, and they have a very good understanding of what the broader offering is. And that's one of the things that's also boosting our onboard spend. And they're able to kind of consider that in the total package. And when they compare that total package between ticket and onboard to what they would be paying on land-based, it's still at a pretty significant discount to what they would pay if they were on a land-based vacation.
One of the other interesting things you talked about on the call is, of course, you, like all corporate leaders right now, are seeing some economic headwinds, or at least conflicting signals when it comes to the economy. But you said you see yourself, if I'm reading your comments correctly, as sort of resistant to some of those headwinds. Explain that to me a little bit more. I mean, do you see people, for example, cancel trips when the economy starts to contract a little bit, or do people stick with it and they just, because they booked it already, they just go on the cruise?
Well, I think it's a couple of things. So one of which is, I think there's a lot of macro trends that relate to the entire population, or a different set of different markets. Now, we source our guests from all over the world, and so a lot of those macro trends could be relevant, but when we get into those trends that relate to our customers with their saving rates, their current wealth levels, when we look at their saving rates, et cetera, and most of all, their propensity to cruise, which is reaching all-time highs, and you combine that with a value gap to land-based vacation, even if that consumer is a little bit weathered, when they're still going to take a vacation. And of course, we're trying to close that value gap. But with that value gap out there, we think those are additional tailwinds to why we're seeing a continued uplift in demand on both volume and pricing.
And finally, Jason, I did want to ask you about Israel and the effect of the conflict there, which you talked about, of course, in the release and on the call, that it's taking out about 1.5% of the capacity, relatively small effect. You also helped evacuate some of the folks there. So what is the current situation? Are you still helping with some evacuations? And, how do you model out something like this, which is so difficult to predict?
Yeah. Well, I think first, we're pretty kind of late in that European season, so we have very few sailings that were really even left to go into that part of the world. Obviously, we reacted when these kind of horrific acts and situations occurred in Israel, and this conflict kind of continues on. It is only about 1.5% of our business, and I think it's important, a few things. One, we have a very kind of balanced portfolio of markets and destinations, and there's always, within this large kind of geopolitical world, there's always going to be some things that do a lot better and some things that do maybe a little bit worse, or some things that we have to turn off. In this case, currently, like the trips out of Haifa, and we build a model to be able to play when it rains, and I think that's really important. For us, when the U.S. called on us, and it was a very easy yes for us to help out, and of course, most importantly, for us to do this pro bono. We felt that was very important. And of course, we're still engaged with the State Department, and we take direction directly from them on when and how we can help get more Americans out of Israel.
And finally, one more quick question as we're talking about international markets here, and that has to do with China, where you guys are ramping up. What do you expect that cadence to look like, considering that it's really been quite a lumpy recovery there?
Yeah, well, we're stepping in with kind of our first toe here, so we'll start operating there in the spring of next year. The Royal Caribbean brand, by far has the strongest awareness and appreciation there in China, and they look for a kind of international experience that's delivered with the China element, and we are masterful at that, as all those guests are really from the China market. So we're stepping into that. Demand looks exceptionally strong, so we're very happy with that. And then as we go through the season, we'll evaluate what our growth expectations will be for 2025 and beyond.
And that was my conversation with Royal Caribbean CEO Jason Liberty. Josh?
Friday marks 1 year of Elon Musk's ownership of X, formerly known as Twitter, and Dan Howley is here with a look back at this rocky ride. Dan.
That's right. Elon Musk is, my cat's also in the shot. I was going to move.
Speaking of rocky rides.
Yeah, go ahead, Oscar. He's not a big X user anymore. He dropped off, along with a lot of other people when Elon Musk took over. And we have some data from Sensor Tower that they shared with Yahoo Finance. According to them, post-acquisition, downloads of X are down nearly 38% compared to October 2022. So that was when the company was acquired. And you're obviously seeing this kind of fall off impact a lot of things, whether that's advertising dollars, which seemingly are continue to fall below where they originally were. There's also the idea that U.S. mobile app downloads are off, down 57%. In September 2023. That's compared to when the company was acquired. So we also have, just to give you more of this data that Sensor Tower is offering, 46 out of the top 100 advertisers on X have completely ceased ad spending on the platform. Again, this is according to Sensor Tower. So, in addition to that, what has Elon Musk done? Well, he's cut huge amounts of employees. There were some technical issues with the company. He changed the name, obviously, to X, which, sure, okay. And then he's also added different tiers. So he's going to have there's the premium plan that you have right now for $8, and there's talk about how there'll be a premium plan with half ads, then a premium plan with ads. There's also the idea that you might be charging $1 per user to try to get rid of bots. He let people back on that were previously banned for posting inappropriate content on the site. And so this has kind of just been the ups and downs of the platform. Look, Twitter's never been a place where people say, I love Twitter. For as long as I've been on it, people have been saying they hate it. It just seems that it's becoming more and more of that kind of feeling. And we're starting to see the impact of this year that Elon Musk has had with the company.
Dan Howley, thank you as always for the insight. And coming up, Ford shares falling after earnings, the company withdrawing full-year guidance until the automaker reaches a labor deal with the UAW. We're going to break it all down next. We just got earnings from Ford, and that stock is falling after reporting mixed third quarter results. The company withdrawing its full year guidance until an official agreement is made with the UAW. The UAW and Ford did make a tentative agreement last night. The union says the deal includes 25% wage increases over the course of 4.5 years, adjustments for cost of living, and the right to strike over plant closures. We turn now to Mark Robinson, MSR Strategy Principal Consultant. Mark is also a former employee at GM. So, Mark, let me get just your first take on this report, Mark. What did you make of the print? Because at least initially here in the after hours, investors seem disappointed.
Well, it's a very rich agreement. They made a lot of important concessions that will result in a significant increase in labor costs over the term of the agreement. They're just doing farmers math. It might go up by $2.5 billion a year in labor costs in between the Canadian auto worker agreement and the U.S. auto worker agreement. So it's
Mark. Sorry.
Yeah, go ahead.
I was just going to say, Mark. Do you think that this gives room for both sides to claim victory?
Absolutely. Particularly for the union, Sean Fain did things differently. He promised to do things differently. He's had run the strike in an unprecedented way, though I would argue it was highly predictable with game theory based on how he came into office and the history at the UAW. And so the key thing he has to be worried about is ratification. So if he gets ratification of the Ford agreement and then extends the pattern to General Motors, it's a massive win for the UAW. As far as the companies are concerned, the only basic good news out of this round of negotiations is that thanks to the strategy that the UAW followed on the strike, is that even though it's been going on for more than 40 days and longer than the GM strike in 2019, it will cost the companies far less, assuming this ratification proceeds smoothly, than that 40-day strike. So the strike itself has not been as painful as it could have been, particularly for one as long as it has been going on. But it is the contract itself creates significant headwinds for all three of the Detroit companies.
And Mark, when you look at this tentative agreement, they seem to have reached perhaps a deal here on issues of wages and cost of living adjustments. What about the battery plants, though, too, Mark? Because that was another issue here where the UAW wanted to see those plants unionized. What happened to that? What happens to that issue, at least as it relates to Ford here going forward?
Well, GM has apparently already agreed to include battery workers under the national agreement, but they were in a different situation than Ford. They had already hired workers at the battery plant, and the workers had voted to be represented by the UAW. So for the GM, it was just agreeing to fold that whatever agreement they are able to reach with the battery plant workers under the national agreement. A significant win for the UAW, but it's still not as difficult as Ford has because they don't have workers. So it's hard to unionize a plant when there are no workers there. My guess is that Ford has agreed to quiet neutrality and an expectation that when the workers are hired and are unionized, that they will be folded into the national agreement. But they haven't announced what exactly they're doing about the batteries.
Mark, what do you think now are the conversations happening inside GM and Stellantis as a result of this Ford agreement?
They're scrambling to assess the impact of the Ford pattern on their agreement, on their companies, on their bottom line. I would be stunned if they did not end up agreeing to pattern economics. It will be almost impossible to get an agreement that's different than pattern ratified, first of all, sent to the members and then ratified by the members. So they will have almost identical terms on wages, pensions, and so on. The issue around battery plants and job security and other sort of individual company issues may differ between the companies, but the economics are going to be similar.
All right, well, we'll keep on tracking it. Thank you so much for your expertise on this issue and your perspective. Mark Robinson, thank you.
That'd be there.
Well, Chipotle stock is surging after it reported third quarter earnings. Here to break down the numbers for us, Yahoo Finance senior reporter Brooke DePalma. Brooke, seeing a 4.5% pop in the shares.
Yeah, Julie, shares jumped nearly 5%, even more than that, after the company beat estimates, largely due to higher menu prices taken last year that were actually hugely beneficial when the cost of beef, as well as queso, as well as other food costs, rose this past quarter. But shares moving higher after the company beat revenue growing 11% to $2.47 billion. That was in line with Wall Street expectations. Adjusted earnings per share also coming in higher than estimates. This past quarter, the company did see higher transaction growth. They also saw margin expansion. And Chipotle CEO Brian Niccol saying in a release that Chipotle's value proposition is stronger than ever as it really looks to position itself for long-term growth. Now the company expects to see restaurant sales growth in the mid to high single-digit ranges in Q4 and for the full year. In addition to that, the company did note that it continues to make headway with its plans to open 7,000 restaurants in North America. This past quarter, they opened up 62 restaurants, which were slightly lower than estimates, but once again, they are working towards that 7,000 restaurant goal. Also important to note here, digital sales did soften compared to the previous quarter. This quarter, we saw digital sales make up 36.6% of total revenue. That's lower than last quarter when we saw it make up 38% of total food and beverage revenue. But Chipotle continues to hold that number steady as it really saw a run-up of digital sales during the pandemic. And of course, the call is happening in just a few minutes. We'll continue to stay tuned for what the company is taking a closer look at as well.
Brooke DePalma, thank you for that. And coming up, it's closing time here on Yahoo Finance. We recap the top stories of the day and get you set for everything you need to know tomorrow. Stay tuned.
We got to look at some of the trending tickers for you after hours right now. Take a look at the Wi-Fi Interactive here. Enphase Energy catching my eye once again, folks. And that's because, once again, we're seeing a big drop in the stock. This has been a really active one recently, and it's just out with its earnings and a forecast that was much below what analysts have been anticipating. Fourth quarter, it says revenue will be at most $350 million. Analysts on average had been looking for $577 million here. The company's gross margin, it looks like, is going to be above estimates, but nonetheless, that is not helping the shares in the after-hours session here. They are dropping some 18%. And you know what? I want to just take a quick diversion over to a heat map that looks at some of these clean energy names. Here they are for year to date, and I'm going to equal weight them so you get a better look at what has been going on here. Nothing good, in essence, because we have seen a decline for this whole space. TAN, which is an ETF that tracks these, there's the intraday. But if you look at it for the year, it's down some 41%. In other words, this has been a heavily pressured sector, and Enphase not helping matters with that earnings report. Then looking at some of the other tickers that we are watching in the after-hours session here, and clicking on over again to see what we are seeing movement-wise. Coursera bouncing by some 16% in extended trading here. That company, too, came out with numbers. In this case, though, it raised its revenue guidance for the full year to above where analysts had been anticipating. The company now says the lower end of its forecast is $628 million. The upper end had been $623 million. So raising that forecast here also is closely because of the changes that we've seen in education, especially spurred by ChatGPT and AI. And then one of the other regional banks reporting, right? Rounding it out, we've heard from many of them. Capital One shares up some 4%. The company's charge-offs better than analysts expected here. $2 billion of charge-offs in the third quarter. That is a little bit below estimates. We've been watching charge-offs closely here. It's one of the measures of how consumers are doing in this rising rate environment. What kind of default rates, what kind of losses are we seeing for the financials as a result of that? Credit card loans rising 3% for Capital One to about $147 billion here for the company. The charge-off rates for auto loans did go higher, though, something to keep an eye on. Josh?
And it's closing time here at Yahoo Finance. Here are some of the top stories of the day. Let's start with Sam Bankman-Fried testifying in his own defense, but only before the judge. Judge Kaplan sending the jury home early in order to decide whether the testimony would be admissible. In the testimony, Bankman-Fried placing blame on FTX attorneys, saying they were involved in key decisions that are at the heart of the case. Meanwhile, Treasury Secretary Janet Yellen speaking out on the recent move in bond yields, saying the surge is a reflection of a strong U.S. economy, not the jump in government borrowing driven by a widening fiscal deficit. Her comments coming after data showed the U.S. economy grew at an annualized rate of 4.9% in the third quarter. That is the fastest pace in nearly 2 years. And meantime, mortgage rates ticking up again this week, closing in on 8%. The average borrowing rate has remained above 7% for 11 straight weeks and has risen 8 weeks in a row. Julie.
And here's what to watch tomorrow. We're going to get more earnings, this time from oil and gas giants ExxonMobil and Chevron, among others. It comes after both of those companies each recently announced mega deals. Remember, earlier this week, Chevron said it plans to acquire Hess for $53 billion. And that's just 2 weeks after Exxon agreed to buy Pioneer Natural Resources for more than $60 billion. In the last quarter, oil prices hit highs at $90 a barrel due to the conflict in the Middle East and cuts to exports by OPEC Plus producers. We're also going to get earnings from Charter Communications, Colgate, Newell Brands, and Phillips 66. And in economic news, we'll have the latest personal income data. Econ data on Friday predicted to show core PCE, which strips out the costs of food and energy, rose 3.7% over the prior year in September. That's down from a rate of 3.9% in August. It comes ahead of the Fed's rate decision next week as it continues to target 2% inflation and PCE, commonly known as the Fed's preferred measure of inflation. That'll do it for today's Yahoo Finance Live. Be sure to come back tomorrow. We'll be talking about all of that and more. We'll be here at 3 p.m.